So off the bat, thank you everyone for coming. So today's webinar topic is on dividend investing with ETFs. I'm Bobby Argyris, Senior Investment Specialist here at National Bank Direct Brokerage. And we're very lucky to have with us today Chris Heeks from BMO, Director ETF Portfolio Manager. And he'll be, I guess, doing the lion's share of off we start, I'd just like to mention that obviously during this presentation, examples might be used. So just please take that with with a grain of salt. These are just they're just examples. These aren't recommendations. It just makes the presentation easier to explain. So obviously you need to do your own research before before going ahead. And you know what? I think it's going to be a very interesting, presentation. I remember if I go back to my university days in my portfolio management class, I remember my teacher would talk about, growth investing, value investing, but he had a very soft spot in his heart for dividend investing. He kept on telling me in our class, what was nice about dividend investing was the fact that, even when things aren't doing so well, you're still getting paid to wait. So, for certain investors, it could be a strategy that could be interesting for you to take a look at. And we're very lucky to have Chris with us, who will take over just a few moments. Chris, you know what? Go ahead. It's you.
Well, thanks, Bobby, and thanks everyone. Great to be here and talk about dividend investing. Just by way of background, I've been with BMO ETFs since 2011, and always focused on the equity and cover call side. But increasingly in the recent years, really focused in my focus onto factor ETFs, otherwise known as smart beta. So like your professor said, the original factor ETFs were value and size. That was, if you've heard of FAMA in French, discovered the original two factors, and that was a Nobel-winning prize discovery that taking a different approach versus the market can lead to better results. Dividends very much one of those as well. So, why would you consider factor investing or consider a dividend-based approach? Again, it's that ability to outperform the market either on, as you mentioned, a risk basis or return basis or combination of the two. At the end of the day, we want to have better risk-adjusted returns, which means return per unit risk. If you look at this diagram, certainly it looks a little bit busy, but this shows you the performance of different factors. And just wanted to set the stage, and then we'll get into dividends because it's a real, interesting area with, I think a lot to kind of dive into. But here you can see kind of the jelly bean chart of factors. You will probably notice, at least I noticed the purple, the quality. Quality's been a very effective factor, and so not the topic of today directly. But we will incorporate quality into dividends, because if you put a little bit of a quality bias within a dividend portfolio, that's going to make the dividends more effective. So we'll get into that. One thing you'll notice if you can, really zoom in with the magnifying glass on this is quality often performs when you have larger market returns. Now you'll see dividends in the dark blue there. When you're having those really high returns, growth stocks are going wild, Nvidia's up 100% type of markets, dividends will give you typically good performance, not as much as the growth stocks. But where you really do see them shine is particularly in more volatile markets. So, when you look at the numbers here, a lot of the years where they're actually outperforming are years where, the market isn't doing quite as good. So again, we'll dive into it, but dividends can be a great way to tilt your portfolio. And so just at the very beginning, take a step back. What do equities do for you? Well, on average, call it 8%. The S&P's been pretty strong. Maybe it's in that little 8-9% range. With recent years, but about 8%. Of that 8%, dividends is on average going to be 3.5% of that 8. Depends on the market. We know now, U.S. has a smaller dividend. Canada's got a larger one, but that dividend is a significant portion of equity market returns. And in particular, as returns compound over the years, obviously the dividends make a bigger and bigger share, have a bigger impact on the overall return stream. And, the next one really gets into the type of dividends. And I think here's where it's really worthwhile to spend the time, because I think your professor, when he said, I like dividend investing, it's the types of dividend companies that I suspect, and I'm sure he was really liked. What are the benefits of dividend companies? Well, they're known as the blue chip, more stable, more mature businesses. But that doesn't mean all dividend companies are created equal. As we know, companies with higher dividend yields, and when dividend yields start getting in that, 7, 8, 9% range, that can be something to be careful of, because, there's the potential of a dividend cut potentially coming. And so that's, popularly we call that the yield trap. That's a yield trap. You don't want to just look at yield alone. And so this is actually one of my favorite slides when it comes to dividend investing. And I'll just walk through what we're looking at here. So this is based on the TSX, so Canada stock market. It's a long-term study going back to 1990, so over 30 years. On the left side, we're looking at return. On that right table, we're looking at risk. So in the market there is the middle. In the middle is the market, the TSX. On average, call it 8% return, 15% volatility, which is the risk measure, right? The volatility of returns. So that's right down the middle. Now to the left, you can see the benefit of dividends. But look at dividends in different categories, if you will. There's dividend growers. And the spoiler is dividend growers are the best. That's where you want to lean into. So that's the spoiler. But you got dividend growers. You got companies who we would call dividend payers, who are kind of sustainably paying out, but not necessarily growing the dividend a lot. And then you have then you have dividend cutters. So companies who have cut their dividend, and then you have non-dividend paying companies. So let's kind of look at that return chart on the left. And again, remember, so the equity market is around 8%. You can see on the left, getting superior return to the market on average over the past almost 35 years, the dividend growers and the dividend payers. So better return, better quality. Look at the dividend cutters, less return than the market. And what's really kind of startling to me is look at the average return of a non-dividend paying stock in Canada is barely positive. And actually, it's only gone positive in the last few years. Shopify has really helped out overall. When I first looked at this chart, can't remember when it was, maybe 7 years ago. And this is a chart I go back to a lot. That number was 0. The average return of a non-dividend paying stock was 0. Think about what that means. Stocks that are more risky, more growth oriented, not paying a dividend. Perhaps it's, investors, you're looking for that next big star, a junior oil company or a junior mining company. And you're hoping they're going to have a big, hit a big resource and go from $2 to $6. This kind of data shows you that, all over the long term, most people, unless you can really figure out where that diamond in the rough is, most people stick to the tried and true, which would be your dividend growers, blue chip dividend growers. So that's the return slide. And sorry if we're spending too long here, but I just think this is such great data. Look at the risk on the other side. And as you suspect, as your professor said, those dividend growers, dividend payers, are mitigating risk versus the benchmark. They're controlling risk. That makes sense. They're bigger companies. They're more stable. They have stable cash flows and hopefully growing cash flows if they're growing their dividend. But look at that risk level of the dividend cutters and the non-dividend payers. Substantially higher risk. So when we go back to what do we want at the end of the day, better risk-adjusted returns. Here's a great example, shows you, leaning into blue chip quality dividend payers in Canada can potentially get you that better return and also that lower risk level.
Chris, Is there, for example, a rule of thumb about looking for a dividend growth rate, or is there like an ideal or I guess like a floor dividend growth rate that investors should look at?
Well, we'll talk about our methodology. We floor it at zero.
Okay.
A dividend payer, so maintaining a dividend.
Mhm.
And we'll talk a little bit more about it. If you look at if GDP is growing at 2%, you would think, well, the dividend should at least be growing at 2%. That's one way to look at it. When you get to the higher single digits, I think that's a good place to be. Banks, I don't have it right off the top of my head, but it's got to be higher single digits or maybe even low double, maybe even 10% over the long period of time. So, I think when you think quality dividend growth names, the banks, and I'll say National Bank is doing much better on the stock price today than BMO, but over the long period of time, we both reported earnings today. For those listening, so National Bank, but over the long period of time, you get that really good dividend growth. So I'd say high single digits as a rule of thumb, but we'll get into a little bit looking underneath the hood, looking at payout ratios, and that's another very valuable tool to assess how those dividends are doing. And get into a little more, I would say, thinking about dividends in this current market. And today we are seeing quite a lot of volatility in the market. It's been interesting that, the VIX, so that call it the fear gauge, the VIX index, which averages around 15 over the long term. It's been depressed. It's almost been like risk hasn't really been in the market. We've obviously had this nice kind of idea of interest rates coming down. That's helped the markets. But you stand back, and I do see quite a bit of volatility in the markets this year. We're seeing a bit of it today. We've got U.S. elections. That's always a market event in terms of volatility. We've got geopolitics, probably the worst we've seen in over 10 years, if not more. And then we still have the pressure of higher for longer interest rates. And it looks like in Canada, we might get a cut in the summer. In the U.S., it's getting harder to see that cut happening over the summer, certainly and potentially even into the fall. So quite a big volatility drop. And here's how you can also use factors really effectively in your portfolio and dividends. And what we're showing here is the performance of dividend growth strategy in periods where you have that higher VIX or higher volatility in the market. And obviously, you see much better performance in the dividends. So when you talk again, I'm just going to keep going back to your professor's comments because they're so, they're so getting talked about getting paid to waiting out volatility, battening down the hatches, if you will, to navigate choppy markets. There you can see dividends, and in particular, dividend growth does an excellent job of that. And we'll just continue on looking on dividends in different market environments. Now, what we're looking at here is changes in the 10-year yields. So you could roughly think about this as changing in the interest rate cycles. As we know, looks like we're at the end of a hiking cycle. So that would be skewed to the right side of this graph. It would be when you were max hiking, and now as we go into the top of the cycle and perhaps rates coming down, we move to the left side of this graph. We have the market return of the Canadian index in the light gray there, or is it light blue or light gray? The lightest one is the Canadian index. You got dividend payers in blue and then dividend growth in dark blue. Now you can see dividend growth is underperforming when interest rates are really going up a lot, when that 10-year rate is going up a lot. And, we're just arguably at the top end of that cycle now. But you can see as that 10-year rate kind of reaches the peak and then comes down, which I would venture to say is the more likely scenario, dividend growth performance becomes better. And again, part of this goes back to that last slide. When the economy is going through that volatility, typically you'll see interest rates come down. And you'll see investors gravitate to higher quality exposures that a well-constructed dividend ETF can offer. So I think no surprise here. And we'll go to the next slide. I think we've got one more kind of market thing to think about, and feels like we're at the end of the inflation cycle. Some would debate that. In the US, inflation certainly looks a little more sticky than in Canada. I believe the latest reading in Canada was 2.7% on the CPI, so certainly getting close to that target of 2%. But one nice thing here, if you look at the dividend, and this is the performance of different factors in rising and falling inflation markets, dividend actually overall does well in both. So that's good to see. Whereas you can see a couple of them have more differentiated outcomes. Size will do better in a falling inflation market than a rising inflation market. Size is equal weight, or same thing for value. So that's another good thing to see, is a dividend can offer some good performance in different market conditions, different inflation conditions. Now, let's just go to the next slide and look at analyzing dividends. Oh, before we get there, what makes a good dividend stock? So we talked about it. It's not just dividend yield. So, I know you're going to show us some tools in a second, Bobby, and I'm looking forward to that, because I love tools. But, don't just sort by yield and think, okay, all in a day's work, I'll just pick the top dividend yielder and we're good to go. There's more to it than that. If you want to be in that dividend growth category, if you want to be in that solid dividend category, you got to do a little more work. And I know you're going to show us some tools in a second, but what are some things you're looking for? Consistent earnings. That's a good quality metric as well. Earnings growth, strong cash flows, low debt to equity in some cases, and dividend increases higher than inflation. So that history of dividend growth. And we'll get into payout ratios in just a second as well, but a payout ratio can be very effective. If a company's earning $100 of net income and we're paying out 50 on a dividend, which is kind of like banks, that's fine. That's sustainable. There's lots of room there. If a company's making $100 but paying $120 out on a dividend, well, that's a higher payout ratio. And I don't think it. I think we can all understand that's not a sustainable metric over the long time. So those are some of the things to look for. And on the next slide, I think we list out just some of those metrics that we use quite closely. So again, you're going to start with dividend yield when you're looking for dividends, and that's fine. But let's go underneath the hood and look further. Dividend payout ratio. So what percentage of earnings is being paid out, or what percentage of cash flows? You can calculate payout ratios in different ways, but either it's going to be earnings based or cash flow based, and you want to see it a lot lower than 100%. 50% is a good place to be. But to your point, what's the dividend growth rate? What's that track record of growing the dividends? And return on equity is another one to look at. And again, that's more of a quality metric. But again, putting a little bit of quality into dividends, makes a whole lot of sense. So I know you wanted to show us some tools, Bobby, so I think I'll turn it over to you.
Yeah, okay, perfect. Thank you, Chris. Chris, in the meantime, maybe you can go on your end to look at the chat to see if there's any questions. Well, actually, some questions came in, so just to see if there's any that you'd be comfortable to answer. And just give me 2 seconds. I'm going to share a different tab. So hopefully everyone can see the National Bank Direct Brokerage website. Just in case if there's some of you who aren't already clients of ours, with us, trading is at zero commissions, whether it's stocks or ETFs to buy or sell. 100 units, 1 share, 1,000 shares. It's at zero. What I wanted to show you today is one of our, at a minimum, it offers you to filter through different criteria. So it's called Strategy Builder, and we can find this under the Markets heading, and it's part of the Trading Central tools. And it's over here. It's Strategy Builder. What's nice with Strategy Builder, for those of you who are looking to, I guess, to build your own portfolio. You want to choose your own stocks. So off the bat, there's a screening tool. So you just click on screening over here. And I have, I think it's about 50 or 60 different criteria. So if we were to stick to if we were to stick to the dividend metrics, I've got dividend yield, dividend growth rate prior year, dividend growth rate last 5-year average, dividend coverage, and again, you can add on, different, for example, you could decide, oh, I'm only looking for large cap stocks. I'm looking for example, I don't know, a certain return on investment, P/E ratio. So really, you can, to keep you, to find the criteria that you're looking for. Now, obviously, if you're not comfortable choosing your own ones, where the tool also excels in is under the Discover section. They have certain themes, preset screens, expert strategy. So I'll just show you one. It's under the preset screens. So here what they've done is they've already created a search criteria. So for example, I've got here top dividends. So stocks paying and growing their dividends for shareholders that see cash income from their investments. Or if I go a little bit further down, I think there's another one. Undervalued dividend payers. But let's stick with top dividends, and if we click on this, and when I get to this section over here, so I have my list, and if I want to see, well, what are these criteria, I can click on bulk edit, and they're here. And obviously, you can play around with this. You can add extra ones, and as you quote unquote fiddle with the tool, your total number of securities will diminish. So for example, let's say let's go for a 3% dividend yield, just to show you. I'm at 354. This one here is looking at Canada, US, but let's stick to Canada for the sake of our example today. All right, we're down to 61. And so I have my top matches over here, and again, we can look at I can filter by dividend growth rate, dividend yield, share type. What's interesting is if I scroll down, so I'll have my entire list, and if you want to find out more on some of these, you can just click on it. But if I scroll down here, I can do a back testing, which a lot of clients appreciate. And to be clear, we're not back testing the top 10 holdings. We're back testing the criteria. So they're essentially running the numbers every month. So basically, it's a buy and hold for 3 months, and then it's sold. They run the numbers again, and then they'll purchase the top 10 holdings. And it's very simple. Calculate. Let's just call it 1, 2, 3. And it just takes a few seconds. Obviously, here we chose Canada, so it's a TSX. If we wanted U.S. securities, we could use the S&P 500. And so I don't know what the numbers are going to come out over here, but again, what's interesting is you can always modify it after the fact. So what came out over here? Okay, so the numbers aren't that interesting on my end, but you can always modify this to your liking. Obviously, what other investors do at the same time is, let's say you're looking at, I don't know, at Pato exploration. Well, you can always take the symbol and go into a research section and read up on the research report. There's usually, especially for dividend stock, they will talk about the dividend as well. So these are the big lines for the research tool. Now I'm going to go back to our presentation. Because obviously, not everyone wants to choose the individual securities. There's an easier option, obviously, if you're looking for exchange traded funds. And for that, go ahead, Chris.
Thanks, Bobby. And the back testing tool, I got to admit, I'm impressed. That is very cool. So how do we put together a dividend portfolio? You want to have a consistent, first of all, we believe in, applying rules consistently, being disciplined with investing, and like everybody else in the world, emotions can get in the way. But having a disciplined process that we run twice a year, every 6 months, we review the data, and in a disciplined way, make the changes. That's a great way to approach it. So what you're seeing with us is for the BMO dividends, it's a very discipline-based approach. We'll start with, a large cap universe of securities in Canada. So we start with I'll use Canada as the example, the TSX. Want to avoid are the dividend cutters. Minimally maintaining the dividend, although we do like the growers. If a company has cut the dividend or doesn't pay a dividend, it's not eligible for inclusion in these portfolios. Then we look at what you see here is the 5-year dividend payout sustainability. So looking at those payout ratios, we do it backwards looking actually 4 years. And then we do a forward looking 1 year, based on analyst estimates. And to summarize it, again, we're looking for companies, if a company is paying out 50% payout ratio, they're going to get a perfect score because we see that as sustainable. But when that payout ratio starts getting 80, 90%, 100%, starts to get a bad mark. And, over 100%, it would get a failing mark. So here's another screen that's going to whittle down that list. Say, okay, you haven't cut your dividend yet, but your sustainability, your payout ratio does not look good. Therefore, it's not eligible. So that brings us down to, a further refined list of possible investments. Now, the way we sort that remaining list is we have got a target number of securities we want to hold. And in Canada, it's 50 securities, so 50 individual equities. We look at total dividends. And what that is dividend yield times market cap. So in a sense, we have two skews within this weighting methodology. We are skewing to dividends and higher dividend yields, but we're also skewing to market cap. And I think that's something that works out very well in dividend-based investing, having both the yield and the market cap. I think where some of the strategies can get into trouble is, a company passes all the screens, it's got a high dividend yield, but at the end of the day, it's a smaller company, and smaller companies just generally have more risk by their nature. But by tying it also to market cap, we're leaning back into those bigger companies, those more traditional blue chip dividend paying companies. So that's how we whittle down to that final 50 for Canada, and we weight by that factor. So if you go look at the top 10 holdings for a Canadian ZDV or Canadian ETF, you're going to see those household names. The big banks are going to be up there. Canadian, a couple railways, Canadian National, pipelines. Same thing in the US. You're going to see, actually, there's a couple tech companies paying a bit of a dividend. Microsoft and Apple, you're going to see Home Depot, Coca-Cola, JP Morgan. You're going to see those really, recognizable household names. And again, so leaning into the market cap really helps put that final touch on the portfolio to make sure it's going to do what we want it to do, which is, give that extra dividend yield, but also mitigate the risk as well. So that's how we do it. And then as we go to the next slide, I think in a sense, we've already answered a lot of these questions. How would you compare different dividend ETFs? And, I think at this point where our heads are at BMO in terms of what we like in the space. You would look at, does the methodology of the dividend ETF, does it consider sustainability? Does it consider payout ratios? Ours does, and we want solid payout ratios. We don't want a company that has a high yield, but it's going to cut it. Are the dividends growing over time? We saw the power of dividend growth, multiple times. How long has dividend growth and payments been analyzed? There's a trade-off there. If you do a 20-year return history, well, guess what? 15 years ago, maybe doesn't tell you so much about what's happening today. But then if you just look at 1 year of data, well, maybe that's not enough either, because as we know, things in a year can change pretty quickly. We look at 5 years on our payout ratios, for example. So you have to find that right middle ground. And the last one is a very important one, obviously. How does the ETF weight the stock? And I think out there's different approaches. Ours, like I said, combines yield and market cap. Some of them just weight by yield. And I think that's something to be careful for, like we've already talked about it. You could have a small company index, a smaller cap company, but if it had a high yield, it could be the largest weight in that ETF portfolio. And then you just have to consider, am I taking extra risk if I'm giving very high weights to small names? Now, I'm not saying there's anything wrong with that approach, but you want to really know that company well. Whereas with an approach like ours, we're leaning into the universe. We're leaning into large cap and blue chip. And you see our top 10, and right away, you'll say, okay, I know these companies. I know Royal Bank. I know National Bank. I know, Rogers or et cetera, pipelines, Enbridge, et cetera. So those are some of the things to ask. And I'll just add, the provider websites are great, should be a great source of information to learn more about dividend strategies. Certainly ours, you can go read white papers and look at the portfolio and learn more about them.
I
think, yeah, go ahead.
Sorry, because I think in general, if you're comparing different ETFs, like dividend focused ETFs, and you see there's a big difference in the yield, I think it's certainly worthwhile to take it a step further and look under the hood, as you'd mentioned earlier, to see what that company's strategy is. Right? It might not meet your particular needs. So in general, most companies they will give an idea of what their strategy is.
Exactly. Yeah. Most of them do it. Certainly we do. I think ETFs are usually more transparent than other vehicles. So like generally, but not every ETF is fully transparent. So that's something to keep in mind. And then, obviously the other thing is looking at performance and, if you've got differing performance and they both say Canadian Canadian dividend ETF, but you have wildly different performance, then I think it makes some sense to maybe take a little look and understand, okay, what is it in the methodology that would be driving such a different performance? And then you can ask yourself, for you, what's the appropriate one? Which one makes sense for you?
Okay. There's a question. I think it goes nice into this particular page. It says, do you include the relation of the security yield to its specific industry standard and typical yield?
Indirectly.
Okay.
So we're looking at the yield. So once those companies have passed all those screens, right? The 3-year dividend growth, they've got the good payout ratios, we've got a list of companies. Then we look at that total dividend metric, which is going to be the combination of market cap times yield. So certainly if a company has a larger dividend than its competitor, it's more likely going to be in our portfolio. So, we do consider that, companies with a higher dividend yield are naturally going to be more able to make the portfolio. But we also do consider the market cap. So you could have a company in the industry and it's got a very high yield. Let's say it's got an 8% yield. It's passed all our screens, but it's a small company. We actually might not include that. We'll say, let's wait for you to become a little more mature. And then now we're ready to have you into our portfolio.
Right. Perfect.
And then if you just want to tackle the last slide, Bobby, and we won't spend too much time on it, and we can spend more time on it. I think you actually just did a session, you were telling me, on cover calls. But again, for that income investor, there's quite a few dividend-based ETFs that do cover calls, and I think we've got 4 of them, where we have an underlying dividend portfolio, and we do cover calls on top to generate even more income. And what are cover calls doing? They're selling away a portion of potential upside in return for income. Again, I don't think we've got time to get into all the weeds of cover calls. Again, with cover calls, I think the big thing is you can be more aggressive or less aggressive. But the more aggressive you get on the cover call side, the less upside on the stocks you get. So you can generate a lot of yield in cover calls, but to generate more yield, you got to be more aggressive. You got to sell away more upside. Or maybe you're even over distributing. Some products, you have to watch that total yield level. They might be a little too high, in my opinion. But so that's where you got to moderate it. Our cover calls, more of a light touch. We're aiming for 3 to 5% in extra income. So add that to the dividend yield of the portfolio. Typically you'll see ours in kind of the 6 to 8% range for our cover call ETFs. And again, very, tax efficient, good way to do it to increase income and take a little bit of risk off as well. So there's, a few options of those are out there. We call it our high dividend cover call suite. We've got Canada, US, Europe, and global. So
Perfect. You know what? There's a few questions about finding ETFs on the NBDB platform. So if I'll just change tabs if that's okay with everyone.
mhm.
So I'll just give you a few seconds to load. You know what? To search our ETF center is really it's again we're visiting our markets heading, and we'll click on ETF center. I'll show you two ways if we're looking for for dividend focused ETFs. I think the easy option is simply just to go under classification, add criteria, and if memory serves me correct, oops, it's called high dividend yields. And we'll register that, and there are 47 categories. We'll get Canadian, the dividend ETFs, US ETFs, but it's very, very straightforward. So, for example, I've got the ZDV since Chris mentioned it. Just put your, if you put your mouse on it, you got basically the breakdown of the information. So this is one way to get, I guess, a large list. Another option, which
I just wanted to mention, Bobby, you could also see the high dividend covered call, the ZW, I believe it was ZWH, which is the US, was right above that too. So nice to see how that's classified in with the dividend ETFs as well.
Perfect. Another option, this is, I actually prefer using this one here. I'm a little more old school. It's under ETF research, and you would click on our ETF research and strategy, and the document that would show up is this one. It just lists all the different ETF research offered by National Bank Financial. But what you're looking for it's called Exchange Trade Funds Canada and US. So this one, last one, is updated on April 9th. So I'll click on that. And essentially what this document is basically it's a snapshot of the Canadian and US listed ETF market as of April 9th. So every single ETF that's out there. So let's say we were looking for Canadian dividend ETFs. We go on Canada Broad Large Cap. And we would scroll down this page, and here we have our dividend income. And again, you've got the symbol, you've got the MER, and there's the distribution. Specifically for covered call ETFs, they have their own section because it would be difficult to just define on your own. It's over here under covered call. We click on covered call, and I believe I need to scroll down a little bit. Here you go, covered call. Sector covered call. So again, they've broken it down by sectors as well. And actually, there's quite a few that are out there. So just it's a nice it's an easy document to use for investors to go to navigate through the website to look at the list. So they're asking about the different comparison tools. Within our ETF center, there is a section called ETF compared. So for example, let's say you could put up to 4 different ETFs. Simply just type in the symbol. So again, Chris provided ZDV, and essentially it takes information from a detailed quote, and you can compare. Again, you can compare the MER, the management fee, the key quote information. I think where a lot of clients appreciate the compare tool is it shows the comparison. So obviously, if it's an ETF that's been around for a long time, you have the 10 years. And one that I've always appreciated, a lot of times, I hold individual stocks, within my portfolio, but I do like to have ETFs here and there to plug holes, or just sometimes just a question of I don't know what to buy. I'd rather just get a diversified ETF. So, for example, if you're looking at the top 10 holdings, so in this case, top 10 holdings, are worth about 45% of of the portfolio. So, for example, if in my case, let's say I'm already overweight in financial services, might not be something that I'd like to look at. Or, for example, if you put another ETF, you can compare it to see, okay, does this ETF help me diversify versus the other one? So this is a decent section for investors to look at when you're using the NBD platform. Any other questions come in the meantime? Or are we good, Chris?
We have one more: bond ETFs versus dividend ETFs. We know bonds have very attractive yields. So bonds, we still have overnight rates around 5%. So short-term bonds attractive. Obviously, with dividend ETFs, you have that ability for capital appreciation as well, which you expect over time. So very complementary though. Bonds can complement equities very well, and that's where you get into the 60-40 portfolio or different portfolio constructions. Obviously depends on your risk tolerance. So very complementary tools.
All right. You know what? I think we've gotten everyone's questions. Maybe give it another 30 seconds, see if anything else pops up. But if not, maybe we can wrap it up. Maybe go have our lunch a little bit earlier than wanted. Okay. You know what, Chris? Thank you very much for taking the time to speak with us. You know what? The information is very pertinent. I think there's anyway, when this becomes available on our YouTube channel, I think it's gonna have a nice longer lifespan in terms of helping clients find whether they're looking for individual securities or ETFs. So thank you for spending the time with us today. And for the rest of you, again, there's visit our website. If you find an ETF that interests you and you want to go a little bit further in the detail, we have certain tools that can help you. But certainly go visit the ETF provider's website. There's additional information that's available there to help you make your decisions. So everyone, thank you very much. Have a great afternoon. Thanks everyone. Bye. See you, Chris.
Take care. Thank you.